Form a strategic rollout. In this episode, we are going to answer the question, can I convert my IRA or 401k funds to be tax-free? I've been helping CPAs and tax attorneys help their clients do this strategy for over 45 years. Get ready to watch some very powerful strategies from a tax standpoint. I've been a tax minimization specialist for this entire 4.5 decades, helping people avoid paying unnecessary tax, especially on their hard-earned savings and the money they've earned throughout their life for their future on their IRAs and 401ks. So my name's Doug Andrew, and if you've watched other episodes, welcome back. If you understand my background, I've helped people optimize their financial assets and minimize taxes for 47 years now. And I'm going to share with you a strategy that has saved some people $250,000, others $500,000, one couple just this last year, 1.2 million. And so there's other episodes that will illustrate those examples. But in this episode, I'm going to give you the overriding concept or strategy behind saving tax on your IRAs and 401ks. Because the problem is most financial advisors sort of convince their clients to sock away money, follow the herd, so to speak, into the traditional IRA or 401k type plan. 403bs, 457s, they're all the same. And 91% of Americans, I think, are duped into putting their pre-tax money or tax deductible contributions to an IRA or 401k, where they get a tax break today on the seed money, so to speak, and the money grows tax deferred. And then later on, they sometimes get this, but they're gonna have to pay tax when they go to harvest the money. So if they were like a farmer, they bought their seed without paying tax, but they later on in life, when they harvest their money, they've agreed to pay tax. And people did that because way back when IRAs and 401ks were first introduced, most accountants said, oh, people will be in lower tax brackets when they retire. That has not been true or axiomatic for over 27 years, but it took the financial services industry until just a few years ago to finally say, ooh, most people aren't in lower tax brackets. In fact, the only people I know of that are in lower tax brackets when they retire are the ones that didn't save very much. Is that why you want to be in a lower bracket? So when I ask audiences, as I speak throughout America, how many of you think taxes in the future are likely going to be lower? I get nothing but crickets. How many think they're going to be the same? Maybe one or two, but I say, how many think they're going to be higher because of irresponsible government spending, the printing of money, and so forth? And a sea of hands goes up. And I go, then why are you continuing to defer paying tax on your IRAs and 401ks, postponing, procrastinating some future perceived unknown advantage and let it grow to this and then withdraw that money when you're in the highest or as high bracket as you've ever been in? Why? Because even normal workers, school teachers, are going down the highway with one foot on the gas pedal and the other foot on the brake pedal, and they don't even know they're doing it. They're putting money into tax-deferred accounts, and then they're killing their deductions in the process. They pay off their house, their mortgage, they don't have that deduction. Later on in life, the kids are gone, or if they're not gone, you can't deduct them anymore. Congress keeps raising taxes. If you're a business owner, then you've lost those deductions. Most people end up killing the deductions, and so that's why they're in a higher tax bracket. In fact, I've found that most people pay back every dime they saved in tax over 30 years on the seed money, the contributions into those IRAs or 401ks. They pay it back the first 2 or 3 years of retirement, and they do it again and again and again. If they live 15 or 20, 25 years after retirement, they pay back 8 to 12 times the money they saved on the seed money. So I've been telling people, get the money out. Don't stretch it out. Don't take RMDs, required minimum distributions. Perform a strategic rollout. Get the taxes over and done with sooner than later. But they go, well, what do I do with the money? Even CPAs go, well, then what do they do with the money if they don't need the money to live on? You don't keep compounding the problem and delaying the inevitable. So let me show you the three-part strategy of a strategic roll out, not a rollover. So make sure you listen to all three parts of this strategy. You don't have to employ all three. I do. And this is what I usually recommend for people who come to me with money trapped in their IRAs or 401ks. And I would recommend you consider this at least 5 years before you anticipate retiring. Now, I mentioned this is called a strategic rollout. I coined this term years ago. I teach this in all of my various books and educational materials. But this is not a rollover. See, a rollover, in my opinion, is like going from the frying pan into the fire. People take money out of their 401k and they roll it over to an IRA and they put off retirement and they're told, well, if you don't need the money, don't take it out, you'll have to pay tax. Keep deferring it until you're age 70 and a half. Well, they just recently increased that age to age 72. You have to start pulling money out at age 72 based upon your life expectancy. The government wants that money out and taxed. They've been waiting for that tax revenue. If you die with money left in there, your kids, if they inherit it, now have to get it out and taxed within 10 years, or else there's huge penalties. It's a 50% penalty if you don't take it out and get the taxes taken care of. So instead of doing a rollover, you want to do a rollout strategically. So here's the 3 steps. Number 1, I'll read this and you can digest it. You strategically reposition your retirement funds, IRAs, 401ks, what have you, subjecting them to tax. You withdraw that money, it's going to show up on the front of your 1040 tax return. There's no way around it. Thus taking care of taxes now rather than postponing and increasing the inevitable liability. We have software that I developed years ago. In fact, I think it's the only software on the planet that shows people the darkness of the night if they keep deferring until they're 70 and a half and then take out required minimum distributions and the tax they will pay if they string it out. And people are flabbergasted. At age 60, 65, if they have $500,000 or $1 million in there, they're shocked that they will pay $500,000 in tax the rest of their life, even if taxes don't go up. They go, that's how much I have in there. Well, it's going to keep growing and it's going to keep giving Uncle Sam 1/3 of everything that you earn from this point forward. Why do you want to have a partner like that? So you want to get it out and the taxes over and done with, because taxes down the road probably aren't lower. So far, so good. Step number 2 is one of the most critical steps to understand why we do this. You want to reposition the after-tax monies. So you pull $150,000 out of an IRA or a 401k, and you pay tax of 1/3 of that, let's say, between federal and state tax, because 41 out of 50 states has a state income tax. So you pull out $150,000, you pay tax of $50,000. You only had a net of $100,000 after paying the tax. That's okay, but stay with me here. You reposition that $100,000 or whatever the after-tax amount is into investment vehicles that will allow you to have tax-free accumulation, distribution, and transfer. Now, there's only one vehicle in the Internal Revenue Code that allows you to accumulate your money tax-free, access your money tax-free forever after. And when you die, it actually transfers, it blossoms in value and transfers tax-free. I'm not talking about municipal bonds or Roth IRAs or anything like that. I'm talking about what I call the L.A.S.E.R fund. And I'll show you how you can get a free copy of my book that explains this. But the L.A.S.E.R fund is a maximum funded tax advantaged insurance contract where I've averaged just a little over 10%, 10.17% to be exact, rate of return for the last 25 years, tax-free. So I reposition the after-tax money into a portfolio of L.A.S.E.R funds. And then it will blossom in value at the end of the day when I pass away. And it replenishes many-fold the amount of tax that I paid. So if I pulled out $150,000, pay tax of $50,000, and I only have a net of $100,000, but if I die the next day, that $100,000 blossoms to $250,000 or $300,000, tax-free. Wait a minute. I pulled out $150,000, netted $100,000, put that $100,000 into the L.A.S.E.R fund, and I die, I get $300,000, or my spouse does, or my kids do. Did they lose anything? No, they came out ahead, because the L.A.S.E.R fund will reimburse you many-fold for the taxes you pay, so you're not out anything. But here's the critical step that I love. Number 3, you offset some or all of the tax liability incurred during the rollout process. This may take 5 years. It could take 7 years. Some people 10 years. I have several examples of this. And you do that by usually resurrecting new deductions that you had been killing. So for example, it could be charitable contributions. It could be mortgage interest. People many times have their house paid off. They have their rental properties paid off and they go, why would I go mortgage those? Because I teach them how money really works. And they go and they refinance their properties and they borrow money. I've had people borrow money at 4.5% on their duplexes, their triplexes, their apartment complexes, their commercial buildings. They borrow at 4.5%. It's deductible. That's a net cost of 3%. They put it in their L.A.S.E.R funds and they earn 9%. How much more is 9% than 3%? They make 300% by refinancing their properties. But what came along for the ride while they did that? They got new deductions. And those new deductions offset the tax you owe while you're rolling money out. You take money out of your IRA, it's on the front of the 1040 tax return, and on the deduction portion, which used to be on the back, now it's down a little bit lower, you offset that income with new deductions you resurrected. And if you'll watch some additional episodes here, I'm going to show you examples of how we have helped people take out money from their IRAs and 401ks and saved $250,000, one man $500,000, one couple $1.2 million. By doing what I just said. We offset the tax liability by creating new deductions, and they got their money out tax-free. Oh, and by the way, they were earning 300% rates of return on their money while they were doing this tax strategy. So I want you to learn how to do this for you. So let me connect the dots. When CPAs and tax attorneys say, well, you take it out, pay the tax, and then put it into something tax-free, what's tax-free? And so I say, well, it's what I call the L.A.S.E.R fund. And I hand the CPA this book. Usually in a day or two, they call back and they go, why didn't I know about this? Yeah, I teach advanced continuing education, but I wrote this book for you. And I'll gift you a free copy. I just pay $5.95 shipping and handling, but this is actually 2 books in one. This side has all the charts, graphs, and explanations of why this is the best dream solution to accumulate your money tax-free, access your money tax-free when you die at Blossoms and transfers tax-free. And I use this for college funding, retirement planning, real estate management, but especially for strategic rollouts. So if you're a left-brain person, you can read this one. If you are not a numbers person, you learn by stories, you flip the book over and read this one. This is about 100 pages, 12 chapters with 62 actual client stories and examples. And what I've been referring to here is a chapter on this side of the book. It is chapter 11, and it's how the L.A.S.E.R fund is used for strategic rollouts. There are 4 or 5 really good examples in here. And then also there is an example when somebody didn't do it right. I'm going to record some additional YouTube episodes talking about these various examples of how the L.A.S.E.R fund was the dream solution. You can go to L.A.S.E.R fund.com. You'll have a chance to get a copy of this sent to you absolutely free. You just pay $5.95 shipping and handling. There's also some other classes you can take and other videos that will help you learn more about this concept.
Bye.